Hello everyone, welcome to Kira's Academy of Accounting and Finance, and today we have reached the final chapter of your 11th standard, that is chapter 9, Financial Statement, part 2, right? Financial Statement part 1, in the previous chapter we discussed what do we mean by financial statement, right? It shows what? The trading and profit and loss account and the balance sheet. Trading and profit and loss account shows what? The financial performance, how the organization has performed in the current year, and balance sheet shows the financial position. In the previous chapter, we just discussed how we will place the things like direct expenses and direct income. We will place it in the trading account. Indirect expenses, indirect income, we will place it in the profit and loss account. And when we talk about capital receipt and capital expenditure, where we are going to show it to them, we are going to show it in the balance sheet, right? But in this chapter we are going to discuss about certain adjustments. Now, why adjustments? Let me recapitulate what we did previously. Okay, in our previous chapter we discussed about the basis of accounting, right? There is a cash basis and there is an accrual basis. Now, when I say cash basis, what does cash basis means? Any transaction, if you are paying money goes out of the business or money comes into the business, only those transactions are recorded, right? Let's talk about a small tea vendor. He sells the tea on a regular basis, okay, and he earns money on a daily basis, and on that basis he will calculate how much he is earning monthly and yearly. He is not liable to pay to somebody. Even though he is liable to pay, he will not consider that as his yearly income, right? He will consider how much he has earned on cash basis. But that doesn't happen in big organization, right? Big organization, they work on accrual basis, okay? Accrued, like they buy goods, they sell goods, they have some creditors, debtors whom they are liable to pay, or somebody is liable to pay to the organization. Sometimes certain expenses are incurred wherein they pay in advance or they receive something in advance. So that for that accrual basis of accounting, we have to follow certain adjustments. Okay, now why adjustments are required? Because what does the profit and loss account and trading account represents? They show the financial performance of the current year. So whatever expenses, whatever income, okay, whatever expenses they have incurred, whatever income they have earned, whether they have received or not received, they have to show, because then only it will represent the true and fair view. Yes, this is our current year's net profit or net loss. Okay, so for that there are certain adjustments, okay, which they get to know at the end of the year. During the year they pass the transaction, but at the end of the year they get to know, okay, these adjustments are to be done, which doesn't represent in the trial balance. Okay, the trial balance we have already given those effects, but adjustments are what we have not given those effects in our books, right? Now, what are these adjustments? Let me explain you with an example. Okay, here I have already prepared trading and profit and loss account of Mr. XYZ for the year ended 31st March 2025. And here it is the balance sheet of Mr. XYZ as on 31st March 2025. So these things from the trial balance I have just placed it. Now I am going to majorly focus on the adjustment. Let me show you what what I have put it in the in the balance sheet and profit and loss account. So obviously the first part consists of trading account, wherein we will show the direct expenses and direct income. Why? Because they are the primary operation, okay, they relates to the primary operation of the business. So we will prepare the trading account, wherein we will first show the opening stock, right? Whatever purchases they have done, less purchase return, the wages they have paid to their workers, freight inward, okay, transportation costs that they have paid to bring the goods into the business. Remember, there is freight inward. In exams it can come freight outward. Outward means what? When they sell the goods, for that they have provided certain transportation cost, right? factory rent. Okay, factory rent where the goods are being manufactured or produced. Similarly, on the credit side, the major revenue is what? Sales, 1,50,000. We will deduct whatever goods we have returned, the goods which we have got into the business, sales return 1,45,000. Now comes the profit and loss account, wherein we will show the indirect expenses and indirect incomes which we do to smoothly run the business. Okay. First is printing and stationery, salary, office rent, bad debts. On the revenue or gain side, there is commission and rent received. Okay. Why I have written all these in the column? Because there are certain adjustments we have to do. Then we will show it in the outer column. On the liability side, what is it? There is a capital. Then there is a bank loan. There are creditors. On the asset side, we have building, debtors, cash at bank and cash in hand. Now let's start the first adjustment. First is what? The closing stock. The stock is there in the business. In the trading account, what we need to show? The profit earned on the goods that we have sold, right? You remember COGS, cost of goods sold. Why we calculate the cost of goods sold? The sales that we have done. On that sales, how much is the cost of those sales, right? Those sales that we get to know from cost of goods sold, and we just revise it. What is the formula of cost of goods sold? Opening stock plus purchases plus direct expenses, we deduct the closing stock. Why? Because closing stock, the stock is still there in the business. There is no need to, that is not the cost of the goods that we have already sold. Okay. So similarly, when we are calculating the gross profit, we need to deduct, okay, the closing stock, right? The closing stock is not a part of the gross profit. So what is the closing stock here? 20,000. So what we will do? We will first show it on the credit side of our trading account, 20,000. Okay. 20,000, right? And on the other hand, where we are going to show, these are the assets that the organization is having. Okay, this is the current asset of the organization. So we will show it here as closing stock 20,000. We can also call it inventories. Okay, inventories. Don't get confused with inventories and investments. Okay. The next is outstanding expenses. There are certain expenses which are still outstanding. There are certain things for which we have not paid the money, but they are current year expenses. Okay, so we need to consider those expenses also in our business because they are current year, right? So what are the outstanding expenses? 2 months salary. 2 months salary. Here they have not shown how much is the amount, right? So what is the salary amount here? 10,000. 10,000 is salary for 10 months. Okay, so 2 months salary will be 2,000. 2,000. This is the outstanding salary. Okay, we still have to pay to our employees that salary. So that is our current year expense. So we will add outstanding salary 2,000, right? So in total, current year expenses 12,000. Similarly, that is our liability. We are liable to pay to the employees. So where we are going to show it? We are going to show it in the liability side as outstanding salary 2,000. Correct? The next is prepaid expenses. There are certain expenses, or we can also say the unexpired. When I say unexpired, it relates to the premium amount. When an organization is taking an insurance premium for, let's say, in the month of July, it covers the whole year. Okay, they have paid it from July till June. Okay, but from April to June doesn't belong to the current year, right? So that is an unexpired, that premium amount has not expired, that is a prepaid amount. Similarly, here I have taken prepaid expenses like office rent paid for the month of April 2025, 2,000. We have already paid. How much? 2,000. This is not a current year expense, so we need to deduct that particular expense. What is the office rent shown? 26,000. So we will deduct this expense, that is a prepaid expense, prepaid office rent. How much it is? 2000. So current year expenses 24,000 we have paid already. So this prepaid rent, where we are going to show on in the asset side, prepaid rent 2000. Correct. Next is accrued income. Income, we are earning an income, but there is certain income which is still, we have not received yet. It is still accrued. Okay, that is our current year income. We need to show in our current year profit and loss account. What is our accrued income here? There is a commission accrued rupees 3000. Okay, so the commission has been accrued. Our commission amount will increase. Okay, so accrued income, it is our asset. What is the journal entry? Accrued commission account debit to commission account. Commission is our income. We will increase our income. Okay, so add accrued income 3000. Okay, this is our what? We are still yet to receive this amount, where we are going to show it in the asset side. Accrued commission 3000. The next is income received in advance. Okay, there is certain income which may be received in advance. It doesn't belong to the current year, so we are not supposed to show that income in the current year's profit and loss account. We need to deduct that particular amount. Income, we credit it. What we need to do now? We need to debit that income. Which is that income? The rent received rupees 1500. This is not current year income. So rent received will be debited. We will deduct it. Rent received in advance. How much? 1500. So current year's rent is how much? 22,000. Correct. Now this doesn't belong to the current year, but still we have received it. We show it on the liability side, that rent received in advance. Okay, we'll credit the rent received in advance. Rent account debit to rent received in advance. The next is depreciation on building at the rate of 10%. Depreciation chapter we already studied. We need to provide for depreciation. How much is the building amount? 40,000. 10% of 40,000 is how much? 4,000. That is our current year expense. Where we are going to debit it? To the profit and loss account. So depreciation will be debited and the building amount will be reduced, so to building account. So depreciation to depreciation at the rate of 10%. 10% of 40,000 is how much? 4,000. And we will reduce the amount of asset, less depreciation 4,000. So our current book value of asset is 36,000. Here you have to remember, if at all in exam it has been given that the depreciation, there is certain addition, or you have purchased any other building or any other asset in the mid of the year, you have to provide depreciation for that particular time only when you have used that asset. Okay, when that asset has been purchased in the mid of year, that means depreciation charged will be for 6 months, right? The next is bad debts. That is, further bad debts is 1,000. In our trial balance we have already shown the current year bad debts 1,000. Okay, at the end of the year we get to know, oh my god, there are some more bad debts, there are some more debtors who are not going to pay us the money. Okay, so we have to provide for that. We have to consider that as an expense. So what we will do, we will add this as an expense, add for the bad debts is 1000, right? Similarly, we will reduce the amount of debtors. Debtors account will be credited, bad debts account debit to debtors account less further bad debts provided. Okay, this is 1000. Still there are certain adjustments we need to do related to data, so I have written it in the inner column, right? Next is provision for bad and doubtful debts. Provision for bad and doubtful debts. Now there are certain bad debts, like we know there are certain debtors who will still not pay us the money, right? So we need to provide for it, right? What is it written? It is 5%. Like my debtors are right now 30,000, but I know 5% of the debtors will still not pay me the amount. So I have to consider that as an expense. I have to provide for it. So what we need to do, 30,000 of 5%, we will consider it as a provision. So provision for bad and doubtful debts account debit to debtors account. So add provision for bad and doubtful debts. How much it is? 30,000. 5% of 30,000 is 1500. So there's one more adjustment I want to do. That's why I have written it in the inner column. Here again we will deduct provision for bad and doubtful debts, 1500. Okay, now let's say there are certain, like last year also we provided for bad and doubtful debts. That provision is still it's there in the in our trial balance. Okay, that is a provision we provided for that bad and doubtful debts. That was last year provision. What effect we need to do it? We have already provided for the current year's bad and doubtful debts. Okay, last year we keep it for the current year, like for this year, like if the debtors doesn't pay, we already provided for it. Now we need to close it. Okay, we don't need those provision. That is a old provision. What we need to do it? We need to deduct that old provision, that is last year provision. Let's say last year provision for doubtful debts was 1500. Okay, so we need to deduct that 1500 and we need to show it our current year bad debts plus provision for bad and doubtful debts as 2000, right? The last year provision that we keep, this year already we are keeping a new provision. So the last year provision, what we need to do, we need to deduct that amount, right? No effect on this because that was a last year provision created, and we will deduct that particular amount from our current year bad debts and provision for bad and doubtful debts. The next is provision for discount on debtors at the rate of 2%. Okay, now this also happens that likewise we discuss in provisions and reserve that there are certain debtors whom we think will pay us the money on time, right? And for that we give this thing that if you pay us in time, that is within a month or 3 months, we will give you a discount. Now if these 28,500 debtors give us the money on time, we have to give them a discount, right? So we need to keep a provision. That is also a current year expense, right? Because this year we have made the sales, there are debtors whom we sold the goods, and we promised to pay them that 2% discount. So this provision also we need to keep it. So how much? On 28,500, not on 31,000, not on 30,000, because 1,000 are cut off, like we cut it off, they are the current year bad debts. Then there is a provision for bad and doubtful debts also, that these debtors will not provide us money, so we kept the provision. Remaining debtors, they will provide us money. If they provide us money on time, we have to give them discount. So our this expense will also increase. Okay, that is an expense, that the discount we are providing. Okay, so how much is the provision? 2%. 2% of 28,500 is how much? 570, right? Provision for discount on debtors. Okay, similarly here we will show it as an expense to provision for discount on debtors. It's 570, so 27,930. Okay, these are my current year's debtors. Okay, now similarly, like how we said earlier that provision for bad and doubtful debts previous year is being shown in the trial balance, what we will effect we will give, these are the old provision, we need to deduct from the current year provision. Okay, similarly when there is a provision for discount on debtors in the trial balance, means that provision is for the previous year, we keep the provision in the previous year. Current year we are providing for new discount on depreciation, so that old provision we will also deduct it from the current year provision, right? Now comes the major part, that is manager's commission. Okay, manager's commission, there are 2 points: net profit before charging commission and net profit after charging commission. Let me just erase it and explain it to you over here. So we now need to calculate the manager's commission. Okay, what is being written? Manager's commission on net profit before charging such commission, on net profit. So we need to first calculate the net profit, right? So first we will need to calculate the gross profit. The total on the credit side is 1,65,000. Gross profit is how much? 52,000. This gross profit will get transferred to the profit and loss account, 52,000, and the total is 83,000. When I deduct the debit, the expenses from here, what profit I got to know? 38,430. Okay, so 38,430 is the net profit. Okay, and the commission has still not charged on it. Okay, we have not charged the commission on it. So in the first point it is written, you have to calculate commission at the rate of 10% before we charge commission on the net profit. Whatever net profit it is, we have to calculate that part as a commission. Okay, 10% on it. So 38,430 is the net profit. On that 10% we will give as a commission, okay, to the manager. So 10% of 38,430 is 3843, right? 3843. I need a calculator. I'm not so good in calculating such amounts. So our net profit after charging commission is how much? It's 34,587. 34,587, right? This is the net profit after we charge the commission. Okay, we provided a commission. Earlier it was written we have to provide a commission on the net profit before we charge commission, like whatever profit it is, on that profit we were supposed to give commission. We give commission and then we are left with the net profit after charging commission. But in the second point, what it is net profit. We have to give manager commission at 10% on net profit after charging such commission. Let's say this is the manager's commission. Okay, this is, okay, sorry, let's divide it. Manager's commission, we will charge this commission, and then on what we are supposed to charge? Net profit after charging this commission, after charging. Okay, on this we have to give 10%. We know the net profit before charging. Okay, we know the net profit before charging commission. This amount we know that it is 38,430, right? This is the amount we know. But we don't know the amount of after charging. How much commission we need to give? We need to get 10% of this. Now how to calculate this, right? We have to assume over here. Don't go in the formula, right? I am trying to simplify it as much as possible, right? Let's assume the net profit after charging commission is 100. Okay, on that 100 we are supposed to give manager commission at the rate of 10%. Okay, so how much we will give? 10 rupees. Okay, this is 10. Now this, if we add it 100 plus 10, what we get to know? Net profit before charging, right? So on 110 we are supposed to give 10 rupees. So on 38,430, how much we will give? This is the basic max formula which we used to do earlier, right? So on 110, this is the net profit before charging. On 110, if we are giving 10 rupees, so on 38,430, how much we will give? So 38,430 into 10 divided by 110, how much we will get? 38,430 into 10 divided by 110, we get 3493.6. 3493.6. Let's consider it as 3494. Okay, so this is the commission we will give. Okay, now let's deduct it. 38,430 minus 3494. What we get? 34,936. This is the net profit after charging commission. Okay, this is the net profit after charging commission. Now let's see, is it correct or not? The 10% of 34,936 is how much? 3493.6. let's round it off. It is 3494. got it? Understood? Like, just have to assume we are not given this amount. This is, we have to assume if it is 100, we need to give 10% of it, that is 10 rupees. We add it, we get 110. This 110 is what? Net profit before charging. So if net profit before charging is 110, and on that we are giving commission of 10 rupees. So on 38,430, how much we will give? We will give 3494, and we are left with the profit of 34,936. 10% of 34,936 is 3494. Okay, easy. Now we will write it over here, whatever you want to write to managers commission, whatever question they have asked you, you have to mention it. We will consider it before charging, that is 3843, and then we are left with net profit to net profit 34,587. Whatever you want to consider in this example, you can consider. Read the question before charging commission. Okay, if the commission has not been charged on it, on that we have to give 10%, or after charging commission, like commission has been charged, after that whatever profit is there, on that we have to give 10%, right? So this is how we will do the adjustment of managers commission. Here we will write outstanding managers commission, that is 3843, right? And the last adjustment could be interest on capital or interest on drawings. Okay, here I have not mentioned interest on drawings. Let's say capital, it is 5%. 30,000 of 5% is add interest on capital, that is 1500. This is the appropriation of profit. We can deduct it from here to interest on capital 1500. So our net profit will be how much? 33,087. Okay, this profit as such is going to be added in the owner's fund. Okay, so the amount will be the same. Add net profit. Net profit goes to whom? To the owner. The net profit is 33,087. Owner is earning nicely, he has invested less capital and he is gaining nice net profit. So the total of this is how much? 64,587. Okay, fine. This is how you are going to show your balance sheet, and your balance sheet is going to get tallied. The amount will be 96,930. I already calculated it to simplify myself. So this is how we are going to show the adjustments. You need to remember, adjustments will be having two effects. Trial balance, we have already given the effect, we have already passed 2 entries, and that show the balances of each and every account, wherein the adjustment there are no such effects have been given, and we need to show that every transaction 2 effects. So we need to show those effects in our financial statement, that is profit and loss account and balance sheet. I hope I did justice while explaining you this particular chapter. Again, I will say you need to do practice, practice and practice. The more you practice, it becomes more easy for you. All the very best for your 11th standard exam. See you in the next video, wherein I'll take your 12th standard chapters. Thank you very much.